Okay, we are live again on Wednesday nights with Brent and Lee. So if you have any comments or questions, put them in the chat. We'd love to answer them. We'll give it a few minutes here, Brent, and let people start jumping on.
All right.
How are you today, Brent?
Wonderful. Great day today.
Good.
Solve some problems today, which is always good, right?
That's always good, man. All right. All right. So we'll get started now. And, ask any of your questions in the comments section if you have any. So Brent and I will answer them. What we've done tonight is prepared a few slides so we can go over what's happening right now in the marketplace. There's a lot of news. There's a lot going on. There's a lot of uncertainty right now in the market with rates and housing and inflation. So we're going to try to go through as much of that as we can, answer any of your questions that you may have. And but before we get started, if you have not ever subscribed to this channel, go ahead and hit that subscribe button for us and subscribe, because we're doing this every week. And then also we're dropping videos every week also on what's happening in the marketplace. So make sure you subscribe, and so that you don't miss any of our real estate tips and tours, right, Brent? You with me, Brent?
Right.
Okay. All right, cool. All right, so let's
I'm with you. Yeah.
All right, cool. So let's get into it, Brent. Let's talk a little bit about rates. That is on everyone's mind right now, rates. So we're going to share our screen here and talk about this slide. So we can see how rates have creeped up on us here. And so, Brent, tell us what's going on right now with the mortgage rates.
Yeah, the Fed's telegraphed what they were going to do as far as the number of rate hikes as far as the Fed funds rate, and that's the rate that banks borrow for overnight funds simply to reconcile their accounts. And so that's been in the news for about 6 months. So it really impacted mortgage rates very quickly before these rate hikes even began. So it was it's baked into the cake, if you will. So what we're seeing in this graph specifically. The bond works inversely with rates. So as the bond is dropping, you're seeing interest rates go up, and what you see there is pretty much a top that occurred several weeks back. And if you were look at the last 2 weeks, we saw it where it tapped that level again and then pulled off. And so, this is where interest rates are, for your high FICO score, 740 plus, 15 to 30 day lock periods, that type of thing. So your situation may be different, but this is a really good graphic as far as what's going on. And you see those rate hikes that the Fed's anticipating implementing, going into play, and what that did to mortgage rates. So we're coming off. Hopefully we're coming off the top of interest rates for the near term, 3 to 6 months, because the bond is starting to say, hey, you know what? We've already responded. In other words, they're grateful. We're grateful that the Fed is taking action, now. And so and the bond market saying, hey, this is about as far as we're going to go for right now. It's looking like it's hitting that top. As you can see, the couple bars there at the top, and then it kind of started to reverse trend. And then we saw it, if you were to see the last couple of weeks, you'd see it hit that again and then pulled back off. So that's about where we're at, about 5.1 for the 740 FICO score, 15 to 30 day lock.
Okay. And, I'm watching the market news as a lot of other people are, and seeing where 401ks are lying and what's going on with the stock market and everything happening. Where do you see, there's a lot of talk right now that Q3, Q4, the Fed is going to have to pull back. A lot of really smart people right now are thinking that Jay Powell might be moving a little too quick here with rate hikes, and that he could end up, throwing us into a stagflation market. So they're talking a lot that Q3, Q4 we could end up having to pull back here. What do you think about that, Brent?
I think so too. I think that, the first quarter we already saw, pullback. Obviously the stock market already reacted to a large degree. I think, we're officially in a bear market. It's off 20%. The first quarter GDP was in decline. And technically, most people's definitions of a recession is two consecutive, negative figures as far as the gross domestic product. So the economy is actually in reverse. It's slowing versus accelerating, which leads to unemployment as companies begin to lay off, and that's our recessionary period that it typically comes in a cycle. And once you get to that point, that's when you start to have to pull back on the tightening, the quantitative tightening. We've heard about quantitative easing for years. The quantitative tightening is a thing as well. You've heard of QE, which is when there's a dovish sentiment towards interest rates. In other words, lowering interest rates, having money, flow into the economy, providing liquidity for loans and acceleration in a growing economy. Tightening is to tighten and avoid some of this inflation we're seeing. But as you know, Lee, there's not a lot they can do about oil and food, really.
Right. There's nothing they can do about oil and food. The Fed can't touch that, and that's going to be a problem for a while, obviously.
Right.
So what do you think of, when you're looking at the current mortgage rates compared to the last 5 decades here? We were obviously seeing, rates that were artificial,
Right.
staying at zero mortgage rates, even though Trump wanted to stay at zero mortgage rates. It's just not, it's not a good
Right.
idea. Obviously, we can see that right now.
Right.
So, what do you think about, so I have a question, I'm getting asked a lot, should someone who's buying a house right now, should they buy down the rate, or should they just come into the rate where we are right now and refinance when rates go down? What's the best solution for them as far as money wise?
Wow.
And a good idea. What are you thinking? I mean, because most people, even though they say this is my forever house, most people move every 5 years. I mean, that's just kind of the trend.
Right.
They upsize or downsize. So if somebody's moving into a new home, they're planning on being there for 5 years, you think they should buy down the rate or just wait for rates to come back down?
That's a great question. And the quick answer is really it depends on the every individual, how long they'll plan to stay in the property. I talk to people where they plan to be in the home no more than 2 or 3 years. And in that instance, obviously you wouldn't want to buy it down because you're not going to experience the low rate long enough to have it, pay off, buying it down.
Right.
For someone that's literally retiring and going into a fixed income, that's the individual that should be, buying the rate down, if you will, and getting a lower rate. Obviously closing costs are increased that way, but you would definitely, after the break-even point, Lee, is about 7 years, where it makes sense to buy down. If you're going to be in the home for over 7 years, it makes sense to buy that rate down.
I mean, right now, where are we at? We're about 5.25 right now.
About 5.25 right this moment. Yeah. And that's with, nominal closing costs. I mean, points, like a point.
Do you think that we could get back into the 3s?
You know what? I saw your thumbnail and I was like, wow, it's kind of true. I think the days of, I think if you're waiting for rates to get to 3, you might be a long time in the waiting. It never happened before. Some of the stuff we saw, the high 2s, actually, we were closing loans in the 2s. If it's never happened before, I think the likelihood of it happening again are quite small. I think it was through the pandemic and really the easing to the point where the fear was just a complete collapse. And so I think that we're getting back to somewhat normal interest rates. And a healthy, hopefully it will bring more of a healthy real estate market. We're still seeing multiple offers, and we're seeing, quite the seller's market is the general sentiment right now out there. And I think that, kind of getting some normalization is probably not a bad thing.
Right. So, right now, I mean, if we look at existing home sales right now, as of April, because the numbers always kind of lag us right now, but you can see that we're back to the 2020 numbers basically here in April. So the market is definitely beginning to slow down a little bit because of these rate hikes. I think it also has to do with gas prices and food prices. Obviously, people just, and then the market's just tumbling. So people feel like they have less money right now. But with that being said, we're still in a pretty strong seller's market. I'm going to put a video together and talk about what's going on. But in the market, but we're still under, under 2 months worth of inventory, which is really pretty low. Nancy has a question here. Answer that one, Brent.
Oh, the buy rate mean. Okay. Yeah. So Nancy, what's possible is you can actually get a lower interest rate, all things being the same. In other words, your income, debt to income ratio, the amount that you're putting down, in other words, the loan to value. So the risk, all things being equal, you can actually get a better rate by essentially paying a point, if you will, like 1 percentage point or 1% of your loan amount. Let's say it's a $400,000 loan. You can pay a point of $4,000 in additional closing costs. Well, that would lower your interest rate, and it depends on the day, possibly 0.18, 0.2, that type of thing. So you're going to lower your interest rate, and that interest rate savings over time, you're making the bet when you buy that rate down or pay a point or 2 points. You can pay 3 points. You can buy that rate way down if you want for the long haul. If it's something you're looking at for, you're going to have it for a full 30 years. You want to buy it down as much as it makes sense initially to close, because you'll be saving after about year 7, 6 or 7. We can run a timeline on it and analysis to show you when you're in the money, if you will, and it's savings from that point forward, and in the form of a lower payment.
Does that answer
and the reverse is true. If you raise your if you raise, you can raise the rate. Let's say you had a difficult time paying the closing costs of the down payment. We can actually do a lender credit, where we raise the interest rate and then we credit you at closing as a lender. We credit you. I'm doing one this next week where our credit's over $4,000. They opted to raise the interest rate a tad and help with the closing costs. So a lot of creative things we can do. We're not set to any set formula. We can actually go to a thousandth of a percentage point. So in other words, if your rate's, 5.211, we can go out and what would be the rebate or the yield spread or the lender credit at 5.212. So we can literally do it to the thousandth percentage point.
How does a builder's lenders react at the last minute if you pay cash and you no longer want to finance? So that's a good question, Lynn. So some builders won't give you the rebate, like if they're offering, like Mattamy offers $5,000 to $7,000, or if you're getting whatever the rebate back when you're financing. A lot of lenders won't give you that rebate back if you pay cash. So that would be one of the things. But other than that, I mean, you're under contract with that house, so you can decide to change at the last minute if you don't want to. I hope that answers your question.
Good
If it
question.
doesn't, just hit. But that's a good question. Yeah, because a lot, and with that being said, sometimes with these new construction, and we put out a video Brent and I did on buying new construction. If they're locking you just at the 30 days, and they don't say, like, I've had clients where they didn't accept some of their income, then you could have to come up with more money if you're on the other side of Lynn's question here, and you're financing and they don't accept some of your income, and you'll know that at the last minute. That's the problem with not having a backup plan right now, especially with things going up and down, and lenders changing their what they're looking for as far as their qualifications. You're very welcome, Nancy. Nancy said, thank you, Brent. So I hope that answered your question, Lynn. So, going back to home sales right now. So if you're on the fence on buying right now, this slide should really, give you some understanding of that. So you can see that, pre-pandemic sales, we're still well above that. We have a ways to go. So, we're starting to see price drops in the market. I had a gentleman called me up the other day. He's interested in selling his home in tradition, and he's seeing prices drop, and that concerned him that prices were dropping. Prices are dropping because right now people are overpricing their homes. So if this is important, if you're a seller right now, and even in the heat of the market, I was telling sellers the same thing that are my clients. Don't overprice your home. Like, there's a home right now sitting in Manderley for $900,000. It's their big one. And that they're never getting that. It's way overpriced. And the thing is that when you overprice your home, you're especially now with the market changing, you're going to end up having to decrease the prices, and that reduces the amount of offers you're getting. Where we just went into contract with one of our clients on $1 million here in Jupiter Farms. The agent priced the home under what I believe the comps are. I believe the house will appraise at $1 million, but he priced it at, like, I think it was 960. And, he got 3 $1 million offers and 2 other offers behind that. And this has just happened last weekend. So, the market is still moving. We're still seeing homes, multiple offers on homes. But if you're overpricing your home, it's going to get no offers, or you're going to get priced, you're going to get offers that aren't where you want them to be. So it's better to work up, and also, terms are very important too. So if we're going into the sellers, where a seller is, the terms of the offer, it's not just always about money. It's sometimes about the terms. So, you want to make sure you're closing, especially if you're moving into a new home. So if you can get what your house is worth, and you can get good terms around it, especially, where that, hey, this is a solid deal, it's going to close, then I think, picking up an extra, 20 grand, waiting around for it, even if you're going to get it or not, is not as good of an offer. Where, hey, look, this thing, the money goes hard, and after the inspection period, you're closing, or you're taking their deposit. So you're in a way better situation that way. So where we're seeing prices decrease right now in the market, it's because the homes are overpriced. So homes are still getting multiple offers, and the market is still moving on an upward pressure, because there are more buyers in the market right now than there are sellers, and there are more people looking for homes than there are people selling homes. And builders, even though they're not selling like they were, they're still selling homes every single day. They're still selling homes. So we can see right now, by the pre-pandemic sales, that we're still way above where we were before. And where we were before in pre-pandemic sales, just so everybody knows, because we know it's been 3 years now, so we're forgetting. Mm-hmm. But we were looking at Martin and Port St. Lucie. I mean, Martin and Palm Beach County were moving at about 3 to 5% a year, maybe a little bit more depending on where you were. And then in Port St. Lucie, you were in double digits, 10%, easily gaining in your equity for the last 8 years. So people have been moving to Florida at big numbers for a long time. Now they're moving at much bigger numbers right now. So we're going to keep seeing upward pressure on the market here in Florida. So,
mm-hmm. One of the things I'm hearing, Lee, from people, the inflation really is one of the reasons more people are moving. I mean, because the high cost of living states and areas of the country, they see, the no income tax here. They see it's relatively affordable. It's the climate and everything. So inflation seems to be the conversation. Some of the conversations I've had with people moving here is like, what, it's expensive to live here. With inflation, I can't afford it anymore. So Florida is a wonderful alternative for a lot of folks.
Well, here's a nationwide map on average days on the market as of April. And you can see that, we're still selling pretty quickly here. We're under 30 days in Florida on selling in pretty much the whole United States. Now we are seeing certain markets, because my brokerage is virtual. So I talk to agents all over the United States on a daily basis. And some markets we're seeing declines, but markets like Florida, Southern California, Nevada, Arizona, Georgia, places that people are going from to are really seeing, some growth. Let's
17 days on the market on average is really low too.
Really
usually
low.
It's usually in months is how it's described. So yeah, that's still.
Brent, here's a good question. Answer this one, Joseph.
Oh, what if you own a house that has a mortgage and you want to buy another that is new construction and finance it? If the builder requires pre-approval, will a lender pre-approve contingent on selling? It depends on the builder. Certainly, you can get approved with that contingency on the loan approval. That's not a problem at all. And in this market, if the property is appraised, or priced right, I think that's something that a builder would consider. Lee, what's your experience with the builder and taking a contingent offer that way?
Well, all these builders are 9 to 10 months out, so at least. So they're gonna go ahead and approve you on the contingency of selling your home, but they like to see the home sold 90 days before the closing. So they're going to really pressure you to do that. So if you get within 30 days, they're going to get real nervous with you.
Especially if there's a lot of options and,
right,
upgrades.
Right.
Those are kind of out of pocket, custom work, that type of thing. Yeah.
Right. So then they usually they have it in the contract. Really, also they want the home sold on the market plenty of time. So, but yes, you can absolutely get a pre-approval contingent on selling. And again, if you're looking to buy here in Florida, talk to Brent, because he's got a little bit easier terms on locking your rate earlier than these builders are offering. I mean, they're offering longer locks, but they're it's not always what the advertising is saying these days. So we're finding that Brent's getting calls. Explain that, Brent.
Yeah, they'll remain nameless, but some are saying they'll lock out a year, and when you get down to the details of it, it's extremely expensive. And so, there is a real cost with locking a loan. Because the rate risk, if you will, falls on the lender versus the borrower, if that makes sense. Because if you're, when a lender says, "Hey, I'll lend at 5.25, let's say, and I'll do that for a month," well, would you lend it for 60 days? How about 90 days? How about a year? Well, I don't know what interest rates are going to be in a year. And so the lender might be opting out of some other opportunities to lend at a higher rate. And so that rate risk, that's why it's more expensive. The lock is more expensive, or the points to get that rate are more expensive. And so, what we're doing right now, we can lock it at 60 days, no cost, and then we can extend to 90. A lot of times with these deals, we just did one today where we're about 60 to 90 days out. And so that's a great option. We may not need that additional 30 days. We can lock out with 6 months right now with no cost, no additional cost. And so that helps. So there's an additional, the rate's just a tad higher, but you don't have to come out of pocket for it. And so that's one big difference that we have that helps a lot of folks to get in and make sure their rate isn't going to completely run on them. But like I said, we're watching the market very close right now. The bond is telling us, hey, we may have raised them enough, and mortgages have already responded to a large degree to the Fed's jawboning, if you will, about
Right.
interest rates. So I think they're selling off their the balance sheet now into the bonds that they have on their balance sheet too. So that's creating additional supply of that type of investment bonds. Mortgages are sold as bonds. So they're selling their mortgage-backed securities and their treasuries. So that's going to add supply, and that's pressuring rates higher too. So I think, as Lee mentioned a little earlier in the podcast, or the show here, the Fed's already pretty much completed from a mortgage standpoint. We see it kind of leveling off.
Right. Mostly it's credit cards and things like that. Cars, credit cards.
Anything tied to prime is going to go in lockstep. It's going to go in lockstep. If it goes up a half, your loan's going up a half. That's because it affects the prime rate directly. That's the only thing it affects directly. Everything else is kind of indirect. It filters through.
Right. So here's the next slide. If you're thinking about sitting on the sidelines, average number of offers going on around the country. So this kind of explains it a little better than the other slide I was showing you. If it's dark blue, the average offers received on a home are 5 or more. So these states are still moving, and I like Brent said before, it's the opinion of us and a lot of other really smart people that as we see inflation higher right now and stay high, we're going to see more people trying to move around, especially as many people that are working from home now. I mean, lots of people are working from home, and they're going to be moving to states where there are lots of jobs. So there are a lot of jobs in states like Texas and Florida, Georgia, South Carolina, North Carolina, Arizona. These are states that are getting a huge influx of people. So they just can't hire enough people. It's just crazy, the amount of jobs that are out there. So we're going to keep seeing upward pressure on the market and prices continue to go up. And, Brent, do you think that, and I have an opinion on this, obviously, but do you think that rates could go much higher than where they are, mortgage rates?
The last time interest rates did this, I lived through one of them. I was just a youngster, where rates doubled. They went from the mid 7s and 8s to 15% to get inflation under control. And that was in the very late 70s, early 80s. And when they double, it has a large impact, right? I mean, it's going to slow things down, certainly. And it did rope inflation in and got things back in line with what was typically normal inflation and appreciation in housing, et cetera, became normalized. So I just don't see it happening without creating a serious recession, and I think that the political pressure, I don't think they'll be able to do that, and I think the markets are going to buck on that. When people start losing their jobs, you just can't start cranking it up. I think that so I think the inflation will eventually be tamed, and unfortunately, we may dip into a recession where the unemployment rate would increase. They actually, no one wants to see that, but it is a way to curb demand and curb
But when you
inflation.
look at when you look at the job market, though, and you look at how many jobs are out here right now,
Right.
Obviously the mortgage industry, you're seeing a lot of people getting laid off because there's not as many refis. But
Right.
I mean, the builders still, they can't get enough employees. I mean, retail here in Florida can't get enough employees.
Yeah.
McDonald's can't get enough employees.
Yeah. We're kind of a unique situation. I mean, because we have so many people moving here, I think that's just a really unique situation in that, it provides a lot of opportunity. I mean, there's really no reason you should be without a job here in Florida. There's so much opportunity that way. And so I think it's we're not going to have so much of a problem here that way.
So, Joseph, are these companies that give you cash to buy compete with all cash offers, and then you pay them rent with an option to buy within a time frame? Scams are worthwhile. So, there are some good companies out there doing this. Some of them are hedge funds that are buying up real estate. They don't want to sell it. They're keeping it because they want to rent it, because there's no rentals out there. If you're looking at the rental market, you'll understand that. So one of the biggest buys right now for hedge funds are housing. So that should tell you something, because a lot of brokerages are putting their cash on the sidelines, and their clients, and their real estate is a huge buy right now. And the brokerages and funds are out there, and they're buying up as much as they possibly can in the commercial and in the residential. And the residential especially, and there's a lot of multifamily, companies that are buying multifamily units, are building multifamily units, and they're, you see them run their ads looking for investors right now. So there are some good companies out there, Joseph, that are doing this. So off the top of my head, I have a list of them. You can shoot me an email and I'll get you a couple of them over. But now, with that being said, you can also do, let's say you're selling your home and you need to stay in it. Because the market is still tight and it is a seller's market, you can do a lease back. So you don't have to get involved with one of these companies, where you could, whoever the selling agent is for you can put it in the MLS that seller would like a 60-day lease back. We're closing on a house, Brent and I, with a client that's up out of state. They already sold their home and they have a lease back on it in New Jersey. And it's New Jersey, right?
I believe.
I believe it's New Jersey. I could be wrong. But anyways, they'll be mad at me if I.
We've got a couple like that, though.
Yeah, we got a couple like that. But anyway, so I think New Jersey. But they're doing a lease back on their home, and that they are living in now, and the home that they're buying, we're leasing back to the seller on that one. So they're staying in their home, the seller's staying in their new home, and they and because he has a new construction that won't be ready for 30 more days. So that is an option, and it is still a viable option, because I was just actually talking to a client today. I got a referral from one of my buddies up in Georgia, and his client needs to sell her home here in West Palm, and then she's buying a home up in Georgia, but she's got to first find a job up there, which won't be a problem for her. But she wants to go ahead and get the cash and put it in her pocket, so she has it. So one of the things I'm going to talk to her about is doing a lease back. So we're talking about a lease back there. So lease backs have become very, very popular over this period of time, where We've been in such a tight market where sellers have been asking, hey, can I stay in my home for another 30 to 60, sometimes 90 days? And working that out with whoever is purchasing their home. So that's a great option too there, Joseph, if you want to do that, where when you finally get to the point where you're going to sell your house, do a lease back option so that you can, just cover their bills on the house until you move out. Not only you don't have to find a rental and things like that, or deal with one of these companies, and you can sell it on the open market, because you are going to get more money on the open market than you're going to get from one of these companies. They're going to give you whatever your house is valued at, where you might get a little bit extra if you have something nice and it's in a good area. So that people are really, well, everywhere in Florida now, everybody wants to move to. You could put a house on the market in Indiantown and have multiple offers on it. Okeechobee. I mean, it's there's just nowhere in Florida now that you're not getting multiple offers. So hope that answers your question. So let's talk about bubbles. All right. A lot of people are concerned about bubbles. Let's see. There you go. All right. So this came out by realtor.com. Experts don't believe the market is a bubble or a crash is in the cards. Like during the Great Recession, the nation is still suffering from a housing shortage that has reached crisis proportions at time when many millennials are reaching the age when they start to consider homeownership. That's likely to keep prices high. And that's what we're seeing a lot of right now is millennials coming into the market right now because they've been able to move around and find good jobs. And a lot of them are now working from home also. So you're seeing a lot of millennials moving into Florida and moving all over the United States. So that is, it's one of the things that's causing upward pressure on the market. I will tell you this too. I believe that builders are still a little PTSD from the 2008 crash, and they're not building as many spec homes as normally they would have, or they could. And I think right now, they're a little skittish right now too. So you might start seeing them backing off a little bit on construction. They have already done that. And a lot of that is just material costs, labor costs, things like that. But where you see them building spec homes, they're selling them here in Florida, like especially in Port St. Lucie, they're selling them like crazy. So, if builders start to back off a little bit because they're afraid of, sitting on inventory for too long, we could see prices increase here in Florida also. So that is something to be aware of.
It's a supply and demand thing. It kind of boils down to the very basics. I mean, the supply is limited and the demand is as strong as it was, a year ago, really. I mean, as far as the number of people that are, interested in purchasing a home, it's just like now it's an affordability issue more than anything. It's getting people to qualify and get them with interest rates where they are. And I believe there's an opportunity down the road at some point in time, there will be an opportunity to refi out of any higher rate that might exist today.
No, Joseph, your questions are great. It helps other people. So please, if you're on and you have questions, ask them, because these are great questions and they ask. Sorry, do a lot of builders make models available to sell with leaseback? I don't really understand that. Can you, do you understand that?
Maybe to purchase a new build and then lease it, or to lease it initially and like an option to purchase it, like a lease initially.
Yeah, I don't know.
I don't know.
I know that they have a lot of spec homes right now, or they have a lot of homes that are in construction. Matter of fact, Emory's finishing up right now. They have homes available. So ask that question if you can a different way, Joseph, so we can understand it a little better. while you're doing that. One of the things I will say right now, if you are thinking about buying and you're looking at new construction, they are super aggressive right now. I mean, I'm getting an email a day, text messages from from the real estate agents that work in the new construction industry, and they are super aggressive trying to get rid of these homes that have either come back on the market because someone backed out because of the financing, or they have homes that are about to be ready, that they are spec that aren't sold yet. They are giving cash. They're giving they're doing all kinds of things. They're doing things with financing. They're doing things with cash when you purchase. Also, some builders that weren't allowing investors to come in and buy the new construction are now doing that also. So keep that in mind, that that's happening.
We're closing a couple loans this next week that if we didn't lock them, there's no way they could close them. I mean, that's kind of the reality of the market right now. So a lot of are falling out, I believe, probably for financing.
I got your question, Joseph. So if you really like a model from the builder, will they lease the builder can use the model show? Yes. So yes. So like Manderley, some of these builders, I know in some of the different communities are selling their models early, and then they lease it back from you, the model. So yes, that is happening. You just have to look for it. I believe that Manderley's about to get ready to sell their models. Then also, which is Mattamy Homes. And then I think that I know that on the 55 and over communities, Esplanade was looking to sell their models. And I'm not sure about Pulte, but I know that it's something that they were looking at too, as their new models in Heron Preserve of selling those. Don't take me to the bank on any of this stuff. But yes, that is something that, that you can definitely look into. And I can help you if you're in Palm Beach County, Martin, or St. Lucie County, because I have a good relationship with everybody. So, but I'm sure that if you said, hey, I want to buy this model, there's builders that are looking to sell them right now, and then lease them back to you. So yes, that's a good question. That is happening though, and has been happening for a while. So Brent, talk about this. Recession doesn't equal a housing crisis.
Last 6 recessions. Yeah. Yeah. The one that in 2008, that's kind of the exception, right? And that's after 8 years of irresponsible lending, frankly. So with the exception of that, you're seeing that during recessions of 1980, 81, 2001, and 2020, all did not really impact housing, as far as this appreciation. They continue to appraise and sell. So in 2008, that was a very specific scenario where, in 2001, 2002, there were lending programs. Many people don't remember this, but what happened was you could get what's called an 80-20 loan. In other words, you put zero down. It wasn't a VA loan or a USDA loan. It was a first and a second mortgage, nothing down. And then it got more and more aggressive. You had to have a 680 FICO score. Then it was a 640 FICO score. You could qualify for it. Then it was 600. Then it was 580. So you're talking about someone that has a 580 FICO score. It's really, not a strong credit profile. And then you got into a situation where it's like, okay, you don't need to show us your income. All you need to do, but if you do have a 640, we'll still do it with zero down. So we got a situation where, their homes were being sold to people with stated income. Literally, some of the situations I saw after in 2009, 2010, where someone that was literally cleaning houses at a hotel and her husband was mowing lawns had an $800,000 house. They started out with an $1,800 payment. It was a 1.9% interest only payment that immediately switched to a fully indexed loan at 9%. And their balance was over $100,000 higher than it initially started. There were some horrible, horrible loans in place in that time. And so when those homes started to, they weren't, people could never afford them. And so, as soon as they adjusted, they were upside down, and there was no out of pocket down payment more often than not on those. And so, when they couldn't afford them, they left them, which created a serious problem and imbalance between supply and demand. There was a tremendous supply coming on the marketplace all at once when all of those loans were adjusted. And so that's what happened that in 2008, 2009, and that's what triggered the recession. But it also caused a housing crisis. It was the reverse of what we're seeing now. Now we're seeing not enough supply and increased demand. So this is a great chart that actually shows you, kind of during those recessions, it didn't mean housing was going to go down. It's a supply and demand thing. It always goes back to that. Lee, I was watching Dave Ramsey. I do listen to him. I agree with about 95% of everything he says. He really thinks a 15-year loan is the best, and sometimes it's just hard for folks to qualify for that or to make those payments. But he was saying, the same thing. He was saying, prices aren't going down with millennials, getting out of the house and the largest buying segment growing every day, and getting, starting families, that type of thing. All those folks are hitting the market with increased demand. So unless supply radically increases, and I just don't see that happening with the supply chain issues and things like that. And like you say, the builders are very conservative now.
Right.
I just don't see it.
Well, and also in 2008, we were in a buyer's market. That's another thing. Gas prices, remember, had hit like $4.50. So we were seeing gas prices really, really high. And a lot of people don't understand is the same thing that got us into the first recession, great recession, was wanting 90% home ownership,
right,
and allowing the Wall Street, the insurance companies, and the banks to commingle money.
Right.
So that's what got us into the first bind. And then economist by the name of Siegel created the Glass-Steagall Act, and that was stuck in to keep that from ever happening again. When Clinton was president, he wanted to get 80% home ownership. You can go back and look at that. And he abolished the Glass-Steagall Act. And so we ended up allowing the banks, the insurance companies, and the mortgage companies to start commingling money again. So the banks were selling all of their bad paper off to Wall Street, and the insurance companies, IG, I think that's it, the big one, right?
AIG,
AIG,
the derivatives,
big one. They were going under. And Bernanke actually wrote his thesis on the Great Recession, and he went in and told the president at that time was Bush, and was Bush, and we needed to give all of the banks money. And a lot of the market didn't like that, but Bernanke's like, if we don't do this, we're going to have soup lines like we did before. And so even the banks that, like, I think Washington Mutual was one of them that didn't have an issue. He made them take the money. He made them all take the money.
Right.
And so they were all under the thumb of the government at that point, and then they worked them way out. And that's why we saw the banks become so sticky on after the fact on giving out mortgages. So you didn't see all the craziness any longer because of that. And, if it wasn't for Bernanke writing his thesis on the Great Recession, we would have ended up the Great Depression. I'm sorry. We would have ended up with soup lines again, because these banks would have had run on the banks because they were going under. They were failing. I mean, some of them did. I mean, Countrywide just failed completely, and Bank of America had bought them, so it threw them in a bind. They had to take money from the government. But AIG, Europe, England actually called the US and said, hey, we need you to bail them out because they're going to go under. They would have been a global crash and that's why you're seeing other economies around the world suffering, because the US is suffering. When we suffer, they suffer. And so we're seeing economies suffering in other places because of the US economy suffering right now. So you will see, that's one of the things that people need to understand. There were a lot of factors to this, but same thing as you were saying, the guy who mowed my lawn owned 7 houses. So that was just craziness back then.
It was absolutely crazy. Some of the things I saw, especially afterwards, because we weren't doing those types of things, but they were trying to refinance, and it was really difficult to hear the stories, and it was just a shame. And these bonds were being sold as AAA credit. It was just crazy. I mean, they were just,
Yeah, and if you watch all the movies, the movie that came out on it, and you read all the articles about it, all these guys knew what they were doing. They knew it. The banks knew exactly what, Wall Street knew exactly what they were doing. They were taking bad paper, CD paper, and just F paper. I mean,
it's horrible.
I mean, it was horrible what they were doing. And, and they knew it. They knew exactly what was going to happen. And they were just, if the market's going up, they're making money. If the market's going down, they're making money. And at that time, when Clinton was president, we hit stagflation, and they were hungry to find a way to make money. And they used this opportunity to start making money again, because Wall Street was struggling back then. Because we had stagflation, which we don't want to have here, and we could definitely have if the Fed doesn't react fast enough. If we start the market starts to fail, and that's one of the things that Wall Street's talking about right now is on mortgage rates. On interest rates of. They just can't keep hiking. They're not going to be able to keep hiking rates if gas prices and food prices remains high.
Right.
So we're going to start wrapping it up here, but I think this is I love this quote. If you're looking to buy a home, I would still recommend you do so, even at the higher interest rates, because we have no reason to believe that home prices will stop appreciating. Again, not enough houses out there, guys. Not enough houses. That we're in a really supply issue. Home values going up, only a problem when you're trying to buy. When you own, it's a gift. So this was a great quote that came out, and I wanted to share it because I think it is so true right now. If you can buy a home right now, you should buy a home, if you can afford to do it, because rents are going to keep going up too. And that's the thing. And you're not getting anything for your money if rents are going up. And as we spoke on our last week about ways of getting into a home, I think it's really important that right now is you can buy a home, even if you're and again, I'll bring this up again. I have clients that aren't buying right now because they can't get what they want. That isn't a bad reason not to buy. If you are approved for a mortgage right now and you can buy a home, buy whatever you can afford to buy. Get into something, because the market's going to keep going up. And if let's say you're somewhere like you're in West Palm Beach and you just don't want to make that trip to Port St. Lucie, but you're approved to buy a home in Port St. Lucie, rent it, take that rent, and pay your rent where you are now. And at least you're making equity as the market moves up. So if you have a approval for buying a home, go buy a home. I mean, don't you agree with that, Brent?
I agree 100%, Lee. I mean, if you look at appreciation, just in the supply demand issue we have right now, I mean, where things are, and I don't see that changing, because I don't see the demand dropping any more than it already has. I mean, demand is really an affordability issue. It's not even demand. There's demand. It's just how many people can afford the affordability. I see that being the only real issue. If we got, if you had a let's say you had, an interest rate hike where your payment's $100 more. Well, you're going to pay $1,200 more over the course of that year. What do you think appreciation is going to do at, extremely low estimate of 3 or 4%, it's going to be up 15, 16, 17, $20,000 on most homes in Port St. Lucie. So, right. So I think you just, run the math on it, look at the differences in the rates. And like I say, at some point in time, interest rates will change. You buy a home, you date your rate. Somebody said to me one time, you date your rate.
So let's look at this. Okay. So if you're not getting, so if you're just looking at $350,000, right, which now is a townhome, right? You can get a townhome in West Palm Beach for $350,000. It's hard to find that single family home. Matamy's building a new community, Cadence. They're going to be starting in the threes, and I'm about to get to Gerard here, but just at 5%, that's $17,500 a year that you're making in equity. If you're not getting a $17,500 a year increase in your income, you need to be buying a house, because that's where you're heading. You're moving at about $20,000 a year, around $350,000, $400,000 in equity a year. You can't go back and get that equity. If you're renting, you're just giving your money to someone else. Here's Gerard, who great guy, and it did exactly what I'm talking about right now. Wanted to move to Florida, had the ability to buy, had some cash in the bank, could get a mortgage, bought a condo where he could rent half of it out and live in the other half. He's now sold his home in New York, gotten top dollar for that. And he's coming down here and he's going to live in his condo while his home is being built in tradition. And then you look, his equity's already gone up $50,000 to $75,000 in the new home. But in the other home, we've got a ton of equity in that home. I think, what did you say? Where are we at right now in that home? I'm going to look it up real quick, because one just hit the market on that condo. Yeah. So Gerard, tell us, kick in what we paid. I think we paid $245 for the condo, and now there's one right next door for almost $320, $319.
Wow.
So, I mean,
that's a great little area
too. The guy's making money. He made $100,000 almost in equity on two houses in Port St. Lucie, and it's not coming back down. Okay, I'm in a contract with Matamy Enery Citron model. I'm currently in New York selling my home. Hopefully it sell this week. Open house. Looking forward to move to Florida. We're looking forward to you coming down, Nancy.
That's right. Welcome, Nancy.
Listen. I'm gonna put a video together on moving from New York to New Jersey to Florida, because people in Port St. Lucie, I think, are putting stuff up on my comments just to keep people like you from not moving down here, Nancy. And you come on down, I mean,
we love it. You're welcome.
We love people coming down here, man. You kidding me? Florida's a great place to live. I know that a lot of people it's starting to get congested, but guess what? It's getting congested everywhere. So you're not going to find a place that people want to live and that's affordable, and you're not getting beat over the head with taxes that no one is Nancy found that funny. So no one's going to every place is going to grow. Every place is going to grow. It just is what it is.
That's worthwhile.
It's an affordable market, and it's worthwhile to live there.
Right.
People are moving there right now.
There's no secret. Florida's no secret.
No secret. It's not
it used to be a secret.
No, it's not. My clients keep telling me that Florida's on the news every single day in all these states that people are moving from. So, people are moving to Florida because it's a great place to live, and you won't get eaten by an alligator, and we're not going to fall into the ocean. Hurricanes, yes, come along, but they tend to be going up the Gulf side here lately. So it's Louisiana and the Panhandle and Texas that's getting pounded here lately. And then, I mean, come on, we're seeing hurricanes going as far as up to New York and flooding New York, New Jersey. So, hey, you know, if you're on the East Coast, you have an opportunity to have a hurricane no matter where you live. So, you know, but so we're going to wrap it up for tonight. We appreciate everyone coming on tonight. We're going to keep doing this on Wednesday, and there are here, I'm going to just hit Joseph right here. There are some lots available in Eastport, St. Lucie, an acre and a half for 100 Brent, but it's only dirt. Would recommend buying land for spec investment. Yes, absolutely. Just be careful where you're buying it, but also land that you can turn into commercial property. Medical and commercial is something that is a great buy right now, Joseph, up in Port St. Lucie and Fort Pierce, by the way, because commercial is coming hard. So we're at 8 o'clock. Thanks for joining us here tonight again. We really appreciate you coming on. Listen, you can leave comments on this video. It'll be up and we can answer those next week, or we'll answer them. I'll answer them, you know, as they come in, but we can, you know, we'll share those with other people. But it's always great when you guys leave comments to these videos, because especially and we can answer those because it helps other people. Also, the video is going to be up. So if you like these videos, please hit the like button after it comes up onto YouTube. When it's sitting there, I really appreciate it. It tells us that we're doing a great job. And join us next week for Wednesdays with Brent and Lee. We really enjoy spending time with you. Be kind to each other. It's tough out there right now. People are stressed out and they need a kind word. So give them a kind word. We'll see you next time.